I'm more concerned about watching where price is going than that of protecting the fact that I might get stopped out and have a losing trade. Now, that's number one rule always, preservation of capital, but clout and saving face publicly is the number one rule for most people on social media today. They don't want to do anything that might be viewing them outwardly from outside perspective, other ones that we be looking at you or them could be very judgmental. And that is many more times costly and expensive and painful than that of a losing trade that you would have done in the privacy of your own, trading without making your results public. And there are lots of folks right now that are wrestling right now because they want to stand out. They want to shake their sword and stand up and rabble rouse. And they're hanging around in break even or in drawdown with only one quote unquote profitable day for the entire month so far. And they're the loudest to talk. And they'll tell you that you're not going to hear sound good advice here when I execute on the sound good advice that I teach. So when you watch a video by me, okay, consider how much information I have on the chart, because it's pertinent to you getting the higher time frame perspective. Everything that's salient, unless I'm doing like, what do you see? Like I'm zeroed in on a small little segment of a price fractal at that time. But when I'm doing a trade and I'm managing the trade, I'm allowing you to see all of the information that I believe that would be useful to you, because I teach grading price swings. You want to be able to go back and look at the dealing range that I'm operating in. And if you have a phone, or if you have your charts on your laptop or your computers, and if you have multiple monitors, if you're so zoomed in that you can only see a small little segment of price action, how can you fully trust what you're seeing on the next few candles is going to be something that is limiting your trade or putting a cap on it prematurely because you're so zoomed in? You're losing sight of something that would be a longer term objective. Now, I learned that lesson very painfully and costly, losing trades that were winners, holding on to really good trades too long because I had my charts zoomed in too tight. And over years and years and years of just saying, I got to take a step back from this, and seeing the charts better than I do now. Well, not better than I do now, but better than I did then. I'd see it now better because I allow for more information. And also, and I mentioned this several times in my discussions and lectures and even on Twitter Spaces, periodically when you're in a trade, especially if you feel like you're second guessing it, like if you're in a trade, it's moved and you just don't know for sure it's going to keep running, step away from your chart. Put your laptop maybe on a coffee table or dining room table. Take a little bit of a distance between you and it and look at it further away. Put more data on the chart and then kind of get a feel for where you are at that moment. Many times it'll give you a different perspective, and you'll see, if you understand how to read price action, you'll see that what you're fearful of, because you're so zoomed in and you're watching that 1 or 5 minute chart and it's fluctuating around a lot because it's zoomed in, and it's causing your brain to pump out this adrenaline and or up to the point of releasing cortisol, which is a stressful hormone. In the last Twitter space, I talked about managing anxiety attacks and panic attacks. And when you're in trades, whether they're profitable or losing, you're pumping chemicals constantly into your bloodstream. And if you are not used to that incurred risk while trading, it can cause you to be, number one, emotional, psychologically amped up, and you're going to make something that is very insignificant paramount. It's going to be a huge thing when it isn't. And typically, for those that want to use a stop loss correctly, we're not concerned about, ramming up the stop real quick to lock in anything, because we're allowing the market to move around and gyrate. And you watched the trade this morning that I had a very specific fair value gap that I did not want to see come back into, and I certainly didn't want to see it close that fair value gap. So when my stop was trailed up, it was trailed up to the bottom of the fair value gap that I did not want to see fill in. My annotation in the fair value gap was, it must remain unfilled for me to trust it, because it's a Friday. Everybody else wanted to go short. They gave you the carrot this morning right at 9:30. They dropped it real quick, took it below the 9 o'clock low. Sell side was purged. The 6:30 low purged. Everything looked like it was a sell to anybody looking at that chart. Typically, on Fridays, there will be a it'll be a return back into the weekly range. So what's the weekly range been this week? Down. So it's going to do what? Likely retrace up into that weekly range, 20 to 30, maybe 40% of the range. So whenever I see a Friday slam down after a bearish week, my mind immediately jumps to, okay, we've already hit so many discount arrays, in other words, targets on the low end. It's reasonable to expect this as manipulation. So that drop down at 9:30 on E-mini S&P, that to me signaled, okay, we're done. But I didn't want to go in there and try to catch a falling knife. And you watched me do that yesterday. That was altogether something different. This could be me reading it as it's a Judas swing, it's Friday, it might retrace back into the weekly range. And if I try to go in there and try to buy the low, and it could just keep dropping. So I required a little bit more. I need to see it get back above the 9 o'clock low. And I need to see it create a fair value gap. And you watched that form. I drew it out. It was retracing back down into that before the 10 o'clock hour. So I accumulated multiple positions using the fair value gap. Stop loss was not rushed up. But once it starts approaching a second target, my second target for the day was 39.40 and 3/4. That level is an old high. We were looking for, obviously, the public to be arm wrestling smart money. Smart money is going to pressure on Friday the street money. Now, street money sees what all week long? The market's been going down. It's going down. It's going down. In their mindset, they're thinking, okay, it's been going down. Nobody wants to miss out on the move going over the weekend because it's probably going to be lower on Monday. So let's get short. So there's an arm wrestling match from a sentiment perspective. You have the informed money, street money, against those individuals that are just trying to catch up. They missed the move, so therefore they must do what? Do what everything and everyone has done to be profitable for the week, which was be net short. And when everybody dropped the market real quick and sudden, just like that, going into the open, CNBC, Bloomberg, everybody's going to be chattering, oh, futures are down, looks like it's going to be a ugly morning. What does that tell the retail trader? They better get short. The market's going down. Get ready for it. I, on the other hand, am expecting TGIF. Thank God it's Friday, okay? What that means is this is a little quirky expression for the likelihood of a retracement back into the weekly range. So the weekly range has been majority lower. So it's going to do what? Retrace back up into that range a little bit. 20 to 30%, as much as 40% of the weekly range. Now, once I see the move start panning out, and if you haven't watched the video I've uploaded on Twitter, I've already shared it. It's been recorded. You can watch me manage it. I give you my views about it. And it's actually trading in a high resistance liquidity run. Now, you probably heard this term, low resistance liquidity run. That's what I teach my students. That's what I like to trade in, those environments where it's just really, really easy to get in, get the stop placed. It quickly runs to your profit objectives and partials. And usually the trade's over like pretty quick. High resistance liquidity runs have much more deeper retracements. They tend to consolidate a lot. They chop around, then move a little bit, go to a new level, then consolidate and chop and then move again. That is a high resistance liquidity. It doesn't mean, obviously, you can see I can find profitability in that. But I try to steer my students when they're first learning away from these market conditions. Now, you might think, and I've read several people over the last 2 days, they're chit-chatting in tweets. They'll say, I can't really learn from these videos when Michael puts them up there with the music. It doesn't serve any purpose. Well, you're wasting your time then, because you need to go into the examples I'm showing and study why those areas are being used for me when I'm taking a pyramid entry, when I'm building my position larger. Why was I buying or selling where I was selling? Why was I taking my partials where I was taking them? Look at the daily chart, the weekly chart, the 4 hour, the 1 hour, the 15-minute time frame. Don't just look at the example I'm showing with that 1 minute chart and think, well, that's all there is to it. You're ignoring the opportunity for you to discover much more about why I was doing it. Because it's not only on a 1 minute chart. The 1 minute chart is just allowing me the medium or time frame to engage in. But you have to have a target, a goal, something. Because here's what you don't realize. You might have a good edge. You might have a good role. You might be dialed in, and your attention to detail is keyed up. You know exactly what you're doing. And you've been consistent for a day, a week, a month, a couple months. And you get this feeling like you're King Kong and you can't do anything wrong. Then you get into that trade that's going to come. And you're going to hold on to it. And it's going to build up a lot of unrealized equity. That means on paper, unrealized potential. If you close a trade, you would get that, but you're not going to, because partials are stupid. That's what you've been telling yourself, and you don't want to subscribe to that. And I have watched my own trades. I've watched my students' trades, and I've watched people that don't trade anything like me get real close to their objectives. And I listened, and I observed, and I watched them arm wrestle the public, because people with more insight than them, more experience than them, simply said, why don't you just take something off here? It's struggling, and you're flipping out, and you're losing your mind, and you're stressing out, and you're all over the place. You're animated, can't sit still, and you're live streaming. That made me anxious, and I don't get anxious in the marketplace, but that made me anxious watching this person squirm over something that is such an easy remedy. You just take something off. That's trade management. That's risk management. And it's also emotional management. You have to manage the person that's pushing the buttons. And money, fear of losing, fear of judgment publicly. Listen, I'm going to call a move, probably a couple of them this year, and it's not going to work. You think I give a shit what you think if I do it wrong? I don't care. I'm going to do it more times right than I'll do it wrong, and it's okay. And I want you to understand that you're going to do it wrong, and because you don't know for certain. You don't know for certain it's going to move where you want it to. I'm proving with my annotations that most of the time I'm right. But today, I wasn't. Even though I was wrong, it didn't go to my 39.45 objective. Even though I was wrong and I saw a fair value gap that I wanted to see, remain unfilled, it filled in, and that was a warning sign to me. I was like, okay, it needs to rip up to that 39.45. If it came all the way back down there, it needs to vault, go right up there, have no difficulty whatsoever. And I've mapped out 2 times where everybody that would just simply watch the first couple videos of my 2022 mentorship and think they got it all figured out and they don't have to watch anything else. I'm going to tell you the folks that took shortcuts where they're going to see the fair value gap, the shift in market structure, and they're going to try to go short. And I'm telling you in the chart, that's not it. Because you didn't watch the entire thing, you didn't back test, you didn't read price, you didn't study, you didn't do any of those things. And you're trying to sell short today. Over and over and over again, wrestling, arm wrestling, because you have something to prove. Well, you're proving that you're not as disciplined as you claim to be. You're not profitable. You're not consistent. You're not precise. And your method's shit. Yin and yang ain't doing shit for you. So if you're going to wrestle with these markets, you don't invite yourself to be wrestling emotionally and psychologically while you're in the trades. So if you feel that tug of war that's affecting your focus, if you're physically talking about it, if you do those types of things, if you make any kind of physical, audible response to whatever the market's doing, that's the surest sign that you need to take something off. You have to do that. If you don't do that, you're literally putting yourself through the ringer for no reason. Because you don't know if your target's going to get hit, just like mine wasn't hit today. I had 2 partials that came off, and I had the largest portion of the trade in the book. My stops were rolled. If it came back, I told you I didn't care. $9,100, but wrong. Say that again. $9,100, and I was wrong. How many times can you afford to be wrong if you don't pay yourself? You're literally in the statistics that this industry talks about, shitting yourself in the first 90 days. Which is why I did today, day 1, 90 days. You'll see every fucking trade, everything, full history, everything. But you will not see that from the people crying about it. They want me to do it. I have no problem doing this, folks. If that's what you need to feel good about this, sure, it's no problem. I do it every day anyway. Like, I'm going to fucking forget how to trade because I got to show you the history. Listen. We're dumb. We're done with all this dumb shit, okay? I'm killing everything this year. I'm removing any doubts. All you have to do is keep showing up. I'm bringing everything. You can't be profitable. You can't make a lot of money with 5 handles. Watch me. Watch my students. You don't need to know where the high is going to go. You don't need to know where it's going to close. You don't need to capture the full AM session move. You don't need to capture the full PM session move. You don't have to be right on your direction. You can be wrong, get in alignment and say, okay, I was wrong there, and you reverse it and do half the position size that I just took a loss on. And end up making more money than you probably would have done if it would have moved in your favor. This is what I'm talking about when many of you are getting into this industry and you don't really know what you're doing and you don't know what to expect. And you listen to these yahoos on the internet. They have no idea what they're doing. These people that can't prove that they can trade profitably, they're the one giving you advice. They're the ones telling you what you're seeing didn't happen. That's lunacy. Like, that is lunacy. Like, that is some Tom Cruise jumping on the couch shit right there. Okay? Like, these are the people you're going to listen to. Just look at this week, folks. I didn't get lucky this week. We're going to do a whole year of this. You need to think about who you're giving your time and attention to. You need to guard it.